Everyone, welcome back to Yuri's Box. In this video, I'll be talking about the upcoming FOMC meeting. Will they cut rates? If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So, currently, market is really not expecting a rate cut in tomorrow's meeting, actually. There's a 97% chance that they won't be cutting rates. And again, if you want to know where to get this kind of information, just go to CME Group, the markets, interest rates, and the Fed Watch tool is what you want. Right here on the left side of your screen, you'll have the current probabilities, and again, you just look at probabilities further in the future right here. And personally, if you've been following my videos, you'll know I'm bearish on the economy, and you'll know that I'm more in the hard landing camp. However, I'm not expecting spikes. I'm not expecting that to come in really spiking fashion. I'm expecting that to be a process. I'm expecting this to play out in the coming months, and it will take time. So from here to there isn't much the Fed can do. Also because of other things we've spoken about in these videos before. Mainly, that the Fed isn't a preemptive organism, it is a reactive organism. Meaning, if you're waiting for the Fed to do something because something might happen in the future, you don't know the Fed. Basically, you haven't been following the Fed. The Fed only reacts to stuff. The only time the Fed is doing something is because something is slapping them in the face. All right. The best example, a recent example of that, is what we saw in the dot plot, for example, from December 2024, and the changes we saw in the dot plot in March of 2025. And if you recall, in one of the last videos I made when I was talking about the Fed, was that my basic speculation was that these dudes right here hanging out between 3 3/4 and 3%, they would basically take the elevator up, and this would contribute them to make a slightly more hawkish dot plot. And the reason for that is because we had some murky inflation reads, and we also had some of the tariff talk, all right? And that was the only thing the Fed could react to. We didn't have any significant weakening in the non-farm payrolls, for example. Everything else was relatively fine, except the soft data. But again, as far as the hard data is concerned, no news. So the only thing they could react to was the inflation side of the story. And that is exactly what we saw in the dot plot. We saw these guys right here take the elevator up and join the party upstairs. And so I could make other examples as well. For example, what we saw in 2022. You might think that inflation being at basically 5%, you might think that the Fed started hiking rates because, hey, inflation might blow out. It already has, but you might think they get their act together and move. No, absolutely not. They actually started hiking rates in March of 2022 when the 2-year yield was already on a tear at 2.3% more or less, and inflation was at 8.5%. All right, they basically started hiking rates at the end of the inflation run. Right, they started hiking rates at the top. If you can also go back and look at what they did in 2008. They went to the zero bound. It was just 2008 was another kind of example because they cut rates a little bit. That didn't help. They cut them a little bit more. That didn't help. Then they got to January of 2008. They cut them by 100 basis points. That didn't help. And actually, I'll draw another parallel in a minute. But eventually, So Lehman Brothers collapses, the whole shebang. You watch The Big Short, you know what happens, and we're at the zero bound. And one of the parallels I could draw just before we move on is between what we saw from January 2008, when the Fed cut rates by a lot. I think they were about, the Fed funds rate was about 200 basis points, so basically 2%. And inflation went up, and everybody was screaming, the Fed made a mistake, we have to hike rates, not cut rates. That kind of sounds eerily familiar to me, well, basically to September of 2024. But again, going back to market expectations, I think that overall this is fairly reasonable. And again, why do I say this? I say this because I'm not expecting everything to fall off a cliff immediately. I'm not expecting the hard data to spike all of a sudden. I'm expecting this to play out through the coming months. And one of the potential, if, how can I put it? My personal speculation on how this process might play out is basically that we might see exactly a replica of what we saw last year. Inflation kind of starts, stays a little bit sticky, but overall the trend is lower. We get to a growth scare during the summer, but with the negative bonus of not having this right here, of not having all the transitory events that took place from September to January that made growth look better and inflation look worse. And so potentially my speculation is that we could see the hard landing side of the story play out from September onwards. So again, it's still quite a bit away. And again, I could easily be wrong. We could even not be in a hard landing. We could be in the soft landing. We could be in a no landing. Again, time will tell where we'll be. And again, coming back to the Fed, that puts us still quite a way away from September. And actually, when it comes down to September now, that is when we have basically 50 basis points of rate cuts priced in. Now, I think this is still reasonable for 2025, all right? And another piece of information I can give you is that my expectation is that precisely because the Fed is a reactive organism and not a preemptive, proactive organism, whenever they cut rates next, I think that will be a 50 basis point rate cut, like we saw last year. Simply because if you choose to be late, you're going to be late. And if you're late, you have to play catch up. And playing catch up means doing more than you would have otherwise would have done. So I wouldn't be surprised actually if the next rate cut comes with a 50 basis point rate cut. And that is far as the Fed funds is concerned. Usually that is the last thing to again, it's a lagging really process, because again, the Fed reacts. Full stop. It waits for something to slap them in the face, and they say, we got to get moving. And even while something is slapping them in the face, like what we saw in the inflation that we had in 2022, it took them a while, to say the least. So don't wait for the Fed to do anything. And I think that this is also a great time to address, a lot of the rate, the yield drama that this time is different, and the Fed won't be able to bail you out because we have inflation. And as far as, that's kind of divided into the short end is concerned and the long end is concerned. On the long end of the curve, what people like to say is that this time is different because you'd expect to see long end of the curve, long end yields decline in the face of a rising recession risk, and this time is different because we're not seeing that. I'll address the first part. Yeah, the first. Well, we're talking about the Fed, so that's kind of relevant. Well, the first part first. The Fed can't cut rates because it's stuck, and that's what makes this time unique. That to me just tells me how long it's been since we've actually lived through a business cycle, because usually that is the position of the Fed and a central bank. A central bank does nothing until something slaps it in the face. All right. And as it gets slapped in the face more and more, it's a race to the bottom. All right. It's a race. Try to catch up, try to catch up, try to catch up, try to catch up. That is how basically, central banks act. It's not that this time is different. This time is more consistent, in my opinion, with the classic boom and bust cycle. Meaning, you go up, you stay up for longer than you would have because you have other things going on. You have growth suffering, but you also have inflation kind of not cooperating. And again, if you don't believe me, the best way to look at it is just look at the inflation chart. What we had, what's this, man? There we go. If you look at 2008, we had inflation going up. We had inflation at 5.6. If you look at 2001, inflation was on the uptrend, and it stayed on the uptrend until May of 2001 at 3.6%. 1990, same story. 6.3%. And again, this is normal, is what I'm trying to say. The fact that the Fed is stuck is actually more consistent with history, with pre-2008 history, pardon me. And again, it just tells me how long it's been since we've actually had a boom and bust cycle. Because again, another piece of speculation I've been talking about on these videos is that the 2010 and 2019 time frame, a lot of people like to refer to that time frame as the time where recessions were outlawed because you had monetary stimulus in the form of low interest rates, and that actually avoided avoided the US going into a recession because again, they were anticipating a recession, and you also had stimulus, on the government side, and so that basically outlawed recessions. I'm in the camp that you should actually flip, all right, that kind of thinking about the 2010s. Rates were low because the Fed and central banks and central authorities were reacting to low growth. We didn't have a boom because everybody was still trying to get over 2008. They wouldn't spend if the stock market went up and their 401k went up. People would just feel good, but they would keep some dry powder on the side just in case another 2008 would happen, just so that people would not get caught with their pants down again in the event of another 2008. And so again, even in the 2010s, that is another example of central authorities react to things. They were reacting to low growth and low inflation expectations. That's why we had those low rates. And again, they weren't proactive, they were reactive, even in 2010. The pandemic kind of slingshotted us out of the 2010s malaise, and we are now, in my opinion, in an environment that is more akin to the pre-2008 world, where you actually have a boom. You have people overdoing it on the upside, on the way up, and people having to pay back that having overdone it on the way up, which is exactly what we saw in the pre-2008 world. And again, just to tie everything back together, in the pre-2008 world, there is only one example of a soft landing, meaning the Fed didn't screw it up, and that is 1995. Right here. And if you actually look at, here we are, 1995, they actually cut rates, and they raised rates and they cut them, but it didn't lead to any hardship. The pre-2008 world is a world where we stay high for too long and we have to play catch up. And we stay high for too long because we have an inflation problem. We had an inflation problem in 1990 with inflation being too sticky. We had an inflation problem. We had inflation not cooperating in 2001, and we definitely didn't have inflation cooperating in 2008. Again, what the Fed has to balance is growth and inflation. If you're in an environment where growth is faltering but inflation isn't cooperating, you're stuck. And so you might want to lean on the side of, defending growth, but you can't go as hard as you might like because you have this inflation problem. And so, therefore, you're just self-fulfilling the prophecy of being late because you're too focused on inflation, as I argue they are today, and eventually they'll have to play catch up. So again, the idea that the Fed can't do anything because we have an inflation problem isn't, in my opinion, such a revolutionary thought. I think it's normal. I think it's actually exactly the kind of environment that central banks were in the pre-2008 world. A world where you had inflation on the uptrend and actually peaking just before a recession. Look at 1990. Look at 2001, look at 2008. And because inflation was peaking just before, stuff hit the fan, they were paralyzed. They couldn't do anything. They perhaps maybe wanted to do things behind, push more on the growth side of the equation, but they couldn't because they had growth still kind of slapping them in the face. So that's part one. Part two. The long end of the curve this time around is cooked, basically, because, and this is something I still have to read someone that says that the long end of the curve will actually eventually go down. Maybe Marko Kolanovic, or Kolanovic, however you pronounce it, ex JP Morgan, is somewhat constructive on the long end of the curve, on duration. But the basic idea this time around is that the long end of the curve, 10, 20, 30 bond yields will not be able to come down in the face of rising inflation, of rising recession probabilities, because this time is different. And we have, this huge inflation problem, which will keep the long end of the curve high. And again, this is touted as, a contrarian view. It is touted as also a revolutionary view, a revolutionary take. And everybody that is a proponent of this view, I consider to hear as, they say that it isn't the consensus view. But the fact that I continue to hear it, to me just says that it is probably the consensus view in this precise moment. Which again, I don't agree with it. Does that mean that I'm right? No, I would be dead wrong. And again, as I said right here, when we saw this blowout in rates in the second week of April, I could be saying this, and this video could be irrelevant in a couple of hours' time, and we have the 30-year at 6%, right? And at that point, perhaps you could say I'm wrong. But again, the prevailing narrative is that we are in an environment where recession probabilities are on the rise, and yet we don't have bond yields going lower. And this is something that I've addressed many, many times. Going into rising recession, an environment where recession probabilities are on the rise, it isn't totally uncommon to see the long end of the curve actually rise. Now, granted, the 2008 cycle isn't an exact carbon copy. All right, I've always expected for deviations, but I'll put the emphasis on basically two events. Event number one is Bear Stearns. All right, yes, we saw from that point on, from really the peak in June of 2007 till really January of 2008, bond yields on the 30-year were really going down. They went down by 100 basis points, granted. But from the collapse of Bear Stearns until June of 2008, we saw the 30-year bond go up by about 65 basis points. Now, what is the collapse of Bear Stearns? What was one of the biggest consequences of the collapse of Bear Stearns? Well, to keep things simple, the rise of recession probabilities. Recession probabilities were on the uptrend, and yields, instead of going down, they were going up. And the same exact example is what we saw in the collapse of Lehman Brothers. What was the collapse? Well, again, what was one of the consequences, the main consequences of the collapse of Lehman Brothers? Rising recession probabilities. And even in the face of that, we saw the 30-year bond sell off by about 10%, going up by 40 basis points. And keep in mind, this wasn't, a normal time. I mean, this was the worst time. This was the worst part of the recession. Okay, we're right here, And that week, bond yields stayed up. Just as Bear Stearns collapsed, bond yields went up. So again, the idea that bonds and special duration should react to rising recession probabilities, to me, is kind of a perversion of reality. And again, why do I say that? Everybody thinks about 2008 and the 30-year bond in relation to this move right here. That is what everybody wants from duration. You see recession, everybody's going to pile into the long end of the curve, because the long end of the curve is a reflection of growth and inflation expectations. If growth and inflation expectations plummet, yields are going to plummet. But the way we got here was anything but linear. Bear Stearns collapse, yields go up. Lehman Brothers collapses, yields go up. They don't go down. Granted, we were in a downward trajectory, but just because recession probabilities were rising, didn't mean that bond yields were going lower. All right, we eventually got there as we progressed, and we got closer and closer, and eventually in a recession, and that's when you saw this move right here. But again, duration doesn't protect you from recession probabilities. It protects you from a recession. And that, I think, is a very important distinction that needs to be made, because otherwise you're using the asset for the wrong purpose. All right, it's like using a hammer against, I don't know, to make a sandwich. All right, you don't need a hammer to make a sandwich, right? Unless you want to flatten it. All right, but who wants a flat sandwich? Duration protects you against a certain outcome. Rising recession probabilities is in an environment where there is uncertainty, not certainty. And in such an environment, what you might look for is gold. And we've talked about this, these two moves, the moves that we saw in from 2005 to 2008, which is quite similar as well, because if you remember, talked about this before, move up, move sideways, and a final top. Move up, sideways, top. Now, again, am I calling this the top? No. But I'm expecting that as we progress through the year, as we start to look through the inflation and look at the fact that the demand shock, the positive demand shock might not be there. And again, I'll address that again in a minute. But as things stand, if things stay the same, in my opinion, we're likely to be entering in an environment that is more akin to what we saw in 2008, where yes, inflation was the uptrend, but because we lacked any stimulus, any stimulant to the economy, it just fell like a rock. And in that kind of environment, when inflation is going down, growth is coming down, you don't want to own gold. You want to own something that protects you against a certain outcome. And that certain outcome is a recession, and the long end of the curve can finally have its time to shine. But until we get there, don't expect any help from from the long end of the curve. All right, don't expect anything major to occur, especially given the fact that we are in a headline-driven environment as of now. We still really don't know. Yes, everybody has their opinion. I definitely have my opinions about where we're headed. But again, as I said yesterday, and about the markets and the Fed just now, the markets and the Fed can only react to what they have in front of their eyes. All right. If the jobs data comes out and it's positive, like we saw last Friday, again, with all the nuance that is associated that you need to consider. But if the job data comes out fine, long end of the curve will react accordingly. On the Fed side of the equation, the Fed will react to what it has right in front of its face. If the numbers are holding up fairly okay, then why cut? If the world is coming apart, we'll cut, and we'll cut by a lot, and we'll have to do more because we were complacent and we didn't cut when we could, so now we have to cut. And now we have to cut, full stop. And that just leads me to the end of the video. And the only thing I want to address is stocks while we're at it as well, because I am in the hard landing camp. But I also recognize that it is important to address a few things. Stocks act in one of two manners. Either the world is falling apart and we have the price in a recession, a la 2008, or the world is not falling apart and stocks go up. That's basically all stocks do. And that's why it's always best to be invested in stocks, because recessions aren't a common occurrence. And if there isn't a recession, stocks go up. So again, that's self-explanatory. But because I always said, and I keep saying, that this will be a process, and from now till the payroll's turning negative, there is still a way to go. What can stocks do? They can go up until they have an excuse not to go up. And last week I said that I wouldn't be surprised if we saw stocks go up to 5,700 to 5,800. Currently, we just wicked up to 5,700. we're pulling back just a bit this week. We're down 1.3%, well, really nearly 1.4%, depending on where we close today. Again, we do have inflation coming out next week. We have the FOMC meeting tomorrow. Again, CPI data, PPI data next week, FOMC this week. They're all things that can move in the short term, stocks in the short term. But until we have something that, an excuse, a reason for the stocks to falter, I wouldn't be surprised if we actually do see some follow through. And one thing I would like to address is also the fact that just because we pierce the trends, or this trend right here, or potentially you might argue, let's see if this right here, for example, we pierced it and we possibly back tested it. If, and this is a big if we are in a bear market, usually the fact that we break a trend line, downward facing trend line, isn't really that much of, isn't really that helpful. Because again, if you look at 2022, this actually occurred many times. I could easily draw, a squiggle right here. This incredibly sharp decline that we had from, basically January of 2022 till the first half of March of 2022, we saw a sharp rise in the stock market. This was about 10%, if I'm not mistaken. That's from the low, 12.5%. And we actually broke through it. And we actually made a higher high compared to the first local high right here in February of 2022. So again, I wouldn't get too excited I wouldn't marry rallies at this point, is what I'm saying. While at the same time acknowledging the fact that, just because growth is potentially slowing down isn't a good enough of a reason for stocks to go short, basically. Either stocks have to price in a recession or they go up. And in this environment, until stocks are given a reason to go down, they will go up. That is basically the moral of the story. So again, to summarize, I wouldn't be surprised if we actually stay put, potentially even until July. I wouldn't be surprised if we stay put until July, simply because by then we might also have some inflation picking up, potentially because of all of the tariffs having an effect potentially. But I expect, unless we see some positive demand, meaning stories, meaning that we get stimulus, immediate stimulus, so direct transfers to people, meaning that we see COVID-like stimulus packages. My base case is that eventually inflation might be sticky, but we're losing growth, and eventually growth pulls everything down and inflation falls like a rock. And because we might have inflation kind of stick around at levels that might be unwelcome, I wouldn't be surprised if the Fed stays on hold longer, potentially even until July. And whenever it is they decide to cut rates, I wouldn't be surprised if they have to do more than they otherwise would have. Meaning, I wouldn't be surprised if the next rate cut ends up being a 50 basis point rate cut. I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.